So what is tax loss harvesting, which has been my
Hmm.
favorite question to ask people lately? Tax loss harvesting is when you intentionally take advantage of a temporary dip in the market. Now, maybe, the fund was worth something, it was worth 50 and now it's worth like 40. So you sell it at a loss. Except we're not going to sit there on the loss because
Hmm.
you don't want to miss out on the potential recovery. So what you do is you immediately buy something else. You buy something that's close enough to your asset allocation. Now, the IRS does not want you to buy something that's substantially similar, is the phrase that they use. So if you end up buying something that's substantially similar, you've created a wash sale, which means that little $10 loss that you've created, you cannot take.
Hmm. Yep.
So the purpose of tax loss harvesting is to be able to take these paper losses because normally when you have a capital loss, you can only take it against a capital gain, but there's a special exception where you can take up to $3,000 a year as a capital loss. Like you can take as an ordinary loss, actually. If you have more than $3,000 in losses, you can just carry that forward. So it's another way that you can strategically, lower your tax bill a little bit.
Hmm. Especially if you plan on having like big capital gains in the future.
The TLDR here is that the IRS is like, the house, and the house always wins. Every strategy you think of where you're like, what if I do this? What if I do that? They've probably thought about it and there's a rule about it.
Hmm.